Hello, fellow traders, fellow futures traders. My name is Curtis from Beyond Backtesting. Today I'm going to be talking about trade frequency and sizing up, scaling up. We're going to be talking about trade size versus trade frequency, frequency approaches to trading versus size approaches. We'll be talking about different philosophies to trading. Before I get started, let me say futures trading is risky. Nothing should be construed as investment advice. But yeah, so we're going to talk about trade frequency, trade volume. Here you see my performance for one of my Apex Trader funding trial accounts for the current month, and you can see my number of trades I place per day, and you can see the volume I place as well. And it's maybe a lot of trades for some of you, but I'm using a very specific approach to this problem. I'll be sharing, some of the pitfalls of some of these methods you may have heard of, and I'm trying to keep this to about 10 minutes. But we go to setups. We need to talk about trade size, trade volume, trade frequency. It's really a lot to try to pack in so that we can really understand what we're talking about. And let's just start from, if you're at a certain place in your trading, right? You may have, when you first started, you may have placed lots of really mediocre trades, lots of bad trades, and over time, you may have heard from reading books and things like, one good trade, or just from reading and learning things that, hey, you need to size up your trades, you need to take your best trades and be more selective and take your setups, and you may have improved your trading. But what I'm here to share is that for most traders, sizing up, scaling up, sizing up your best trades is probably going to be a mistake. And as well, the type of trading you were doing before that, taking lots of mediocre bad trades, is also a mistake. So they're both mistakes, in my book, right? For most traders, obviously, everyone has. There's going to be exceptions. There's going to be different. People who are different. I'm going to talk about one of those exceptions, what those exceptions are. But let's start with some of the problems with the trading sizing up your best trades. And one of the problems is simply, unless you have a very good knowledge of your edge, both backtesting and experience, you're not in a place to size it up. You're not in a place to size up unless your edge is very consistent and very good risk. It shouldn't be sized up anyway. And it's very hard to find edges of that nature that are frequent enough to take advantage of on a regular basis. Okay. So basically, your edge is probably not worth sizing up. And so you may be looking for that edge where you can size it up. That trade you can take with a one tick stop, right, or two tick stop. You say, I can size this trade up, right? And it's very difficult to do that in today's markets. So what I'm doing is a different approach, and I'm not saying this is the right approach, but it's an approach that makes more sense to me than trying to do that. Is that if you have an ability to scalp, if you have the ability to read the market, then you probably are around 70%. Let me say this. You can see here my performance is around, this is discretionary trading, and you can see what my win ratios are, okay? So if I were to build a trading system, a quantitative trading system, or a setup, the win ratio on my setup, on my very best setups, are probably going to be like, and the ability to get trade frequency enough to make it actual day trading, no more than 70%, right? Look at me, 70% would be very good. And you can see I'm doing 70% and better most days. So the problem with a setup, and I've did this before, I've approached this way as I look for a specific setup. The problem with the setup, trading as a setup, or trying to find, a specific edge in the market, quote unquote edge, is that you really become a niche trader. And the market can throw a lot of different stuff at you. And if you're looking for one thing, and if you have any ability to trade, then you may be better off just trading, because you're going to be trying to trade that setup in environments where it's not suitable. You're going to need more than one setup. You're going to need at least, probably, I would say, 5 setups. And then maybe you could take that approach. Or you're going to need a setup that you can use that's flexible, highly flexible. For example, there are, I'm not going to share the examples, but there are many approaches where you can have setups that are very flexible. They're not really edges, like they're not things that you can backtest. Okay, if you can take an idea, a concept. I can see stuff that works at for just a couple ticks that could also be traded on the day. It's the same concept, but that's a conceptual type of a setup. It's not a it's not a real setup where you have rules, where you know the environment where it does well. You can say 1, 2, and 3. You can grade the trade. That type of setup is the type of trade you can size up, not some trade where you say, okay, it's trading a certain way or something happening in a very broad sense where you can do that. But that is more flexible, and you can certainly use that to help your trading. So, so what I recommend in terms of risk is constant risk. I've tried to, and I've changed. And in the past, I said, I take my trades when I'm more confident. I size those up, and I may do that just a little bit, but not very much. Not very much because, it introduces risk that's not needed. Really, that's the essential of it. With constant risk, if you're, basically you risk a certain percentage of your account or a certain percentage for a certain type of trade. Now, in my approach, I'm targeting $100 per day. These are trials. So if I can do 100, that could be $2,000 of actual income at Apex Trader Funding. Use my affiliate link down below if you want to, take a trial. But that could be up to $2,000 per day if I had 20 accounts replicating it, right? So, so where was that? Okay. So I'm really more of a fan of constant risk sizing, but I will allow my scalps and risk trades to have a different risk limit, right? So I can see that if it's a scalp for my 1R on a scalp for me is $50, 1R on a risk trade is $100, and that's the most I generally want to risk on those trades. I do have a daily loss limit. If say for some reason I decide that it would be really bad to take a stop loss at 100. Then I still have a daily loss limit that can catch me. If I miss that, because I know sometimes I've had performance discipline problems, I have a liquidation limit above that, right? So my daily loss limit is 200, my target for the day is 100, and my liquidation level is going to be somewhere above 200, depending on where I set it up. It's going to be always above 200, always above. You always want your liquidation above your daily loss limit so that you are always shut down. You never want to be getting liquidated. Let me just say this: never want to be getting liquidated by the software, because it will hurt your performance, okay? And when you're close to your liquidation limit, if you're close, if you're at your daily loss limit and you're going to get liquidated, place another trade, don't even do it, just going to mess your performance up. So that's why I put my liquidation limit above my daily loss limit. So there's no excuses if I get that hit. But yeah, so trading volume, trading size, right? We're talking about these different concepts, and essentially, you don't know what trade, you could think you have the best trade of the day, and it could turn out to be the worst trade, right? And so that's why I'm not unless you have a very quantitative type of an edge, I'm not a big fan of sizing up your trades, right? So you need a lot of experience to do it, and it's something that could be hurting your trading, actually. If you're just trying to figure out how to size up your trades and get better because you've heard, hey, I take less trades, take your best trades. That's one approach, but that assumes that your trades are really good. And it assumes that you're also, psychology-wise, I don't even want big losses in my discretionary trading. Now, if I have a system that I've back-tested, I have, some stats on, maybe that's different. But I've just found in my discretionary trading, I don't want big losses. I don't want to lose, say, $500 or whatever a big loss is for you, and then come back in the next day and have to trade again and potentially lose that again. Even if that might be a little more profitable. So what I'm doing in my trial accounts is I'm targeting a consistency approach. I'm targeting $100 per day. It's not a lot, and I might do 300. That's the whole point of it, is I'm targeting way less than my ability, and that's why I have, I can be. That's kind of the idea behind it. Is make it so achievable that it's not even a problem, right? So we've talked about how sizing up can be a problem because you don't know what trades are your best trades. Even if they are good trades, you have to come back after a loss. Your consistency is not going to be there, and it's hard to find enough trades, right? So if you're going to use a sizing up approach, let me just say if you're going to do that, you're going to have to become a real expert in your trades. And you probably got to have multiple trades you're an expert in, and you're probably got to wait for them, and you're probably got to take some hits, and you're probably have some big days and some big winning days and some big losing days, and you may make a lot more doing that. But that's kind of the problem with sizing up. And we know taking lots of mediocre trades, right? What's the problems with that? If this is probably where the beginners are, which is more similar to how I'm trading, but I'm doing it differently than what the beginner is. So if you're a beginner trader or a novice trader, you're taking lots of mediocre trades. You're not getting value on your best trades. You're not getting the value, right? You're just churning, right? You're just you're taking mediocre trades. You're taking more trades than you need. You're trading because of the wrong reasons. All of those things, right? And then there's a way to take that, and this is where I feel like the magic is with what I'm doing. You take that and then you refine it. Okay, you refine it. Okay, so I'm using a type of a targeted volume approach. And there are some secrets to this method that I'm not willing to share. If I have I'm not sure if I mentioned it in this video yet, but I have a trader course, scalping, what do I call it? Scalping the enigmatic. What is it? Let me see what I called it. Yeah, so scalping the enigmatic art. The enigmatic art, where I can share more. But essentially, right, if you're interested in that, email me at curtis@beyondbacktesting.com if you're interested in learning how to do that. But essentially, all I care about is making $100 per day. Okay, I'm just really, really basic. Okay, and you say, well, $100. But again, remember that could be $2,000 per day. It's just a number. It's just you consider it 1 R, okay, or 1/2 R, because I got 2 R risk. All I care about is making, on my daily risk 1/2 R or $100 per day. Okay, however you want to think about it. That's all I really care about. I don't care about having a big winner. I don't care about putting up more on my best days. I don't, so really, and I don't care if I have the very best trade in the world and I make $100 on it. Okay, because the best trade can also turn around on you. And so with this type of a goal, and I care about consistency. I want to be consistent. I want to be winning. Preferably like 19 days of the month. Okay, really consistent. And so I'm using a targeted volume approach or a targeted frequency. And there are some intricacies to this to understand how this really works. But think about it this way: if you want to make $100 per day, what do you need to do that? Okay, mathematically, I could have 5 $20 trades or 4 $25 trades, $100 trade, right? You can break it up how you want to. You might have 3 $33 trades, but so knowing that, how many, if you do 1 trade a day, like you're one and done, or you're take your best trade, that could be not the best trade of the day. You could have been fooled, right? Then you have a long losing day, and you can't recover if you find a better trade, right? So it probably needs to be more than 1 trade, although, maybe you find a really good trade, you could do that, but I really don't want to be risking my whole risk unit on 1 trade, right? You probably need to have at least the ability to take 3 trades a day, right? So you say, or two or 3 trades a day. So then you just do the math and you say, okay, what kind of risk per trade? And, you just kind of work it out. But so there's not a specific, here's the other part to that. So that's the basics of it, okay, with a trade frequency approach. And the reason I want to do that, the reason I pursue it this way is because if I'm wrong on that trade, on that best trade, and I've seen this happen so many times, a really super great trade comes up and it's not the right trade for that day, and it's the wrong trade. Or it was a good trade a moment ago, and now 1 moment later, it's not a good trade, right? I mean, how many day trades really are great trades you can say for the whole entire day they were the best trades, right? They were great trades. That's probably only going to happen at the low of the day and the high of the day, where you can truly say all day that was, so that's what a great trade is. You come back at the end of the day and you say that was the best trade of the day. You can look back at it, right, and say, or else, 1 moment later one little moment later would have changed that, right? And you usually only have 1 or 2 of those trades a day, maybe 3, right? Where you can really say they're great trades. And so that's why you get, caught. It's because you're taking a trade that's a great trade in the moment, and 1 moment later, things have changed. And that happens so frequently during day trading. Happens so frequently. It happens, and typically I see about 4 shifts a day in the structure and how the tapes trade and everything. You might see 2 to 4 shifts per day, and so that's a lot of opportunity to get caught, or a lot of risk to get caught. But what we're trying to do is take that trader who think about when maybe you first started day trading, you took a lot of mediocre trades, you traded a lot, right? We're trying to take that type of approach and become very selective with it, and very selective. And there's not a certain number of trades that I'll say that it's the right number. It really depends on how strong I am at that frequency. Like today, I placed 108 trades. That sounds like a lot to me, but I was pretty strong. It's probably too much because my after cost was too low, but I was pretty strong in the frequency I was at today. So that's what I'm talking about in terms of there's levels to this, right? It's not just 20 trades, 20 times. The basic of it is simply $20 a trade times 5 is 100. That's kind of the basic. That's kind of like the underlying math, but there's more nuances to it in the sense of it also depends how the market's trading, what type of opportunities it's given me, and also where I'm strong at. So if I'm strong taking 2 tick scalps on the day, that's fine. If I'm not strong there, right, and this is where I have to review, if I'm not strong, then that's the wrong frequency. And that's where the real magic is, right? So I hope this helps, but I wanted to share this because, a lot of traders have this idea of, getting really big on one trade, and it really can be very harmful to your finances if you're not truly there, right? And even if you are, that type of trading, if it goes bad, it goes really bad. And I just want to show you here there's a different approach where, yes, we're not doing trades, mediocre trades. We're not trading undisciplined. We're not trading mindlessly, right? Everything is conscious. Every trade is recorded. Every trade I call out loud, or I'm supposed to, right? It's part of my checklist. Every trade has a reason, right? I'm being selective, right? I'm being selective. Every trade is selective. Every trade is, but instead of taking, just imagine this, instead of taking 2 or 3 selective trades per day, what if you could take 10 selective trades per day? You have a lot more opportunity. And that's what we're really talking about. Can you take 10 selective trades per day? So that's really the difference, right? And if you're going to do setups, right, then you're going to need, and you want to trade consistently, be able to trade every day. You're going to need more than one setup. You're going to need to become a master of 5 setups, or you're going to need to have a very flexible setup that you can use in a lot of different circumstances, which is going to have, you're not going to be able to say, it's going to be harder to really define the edge on that type of a setup because you got to be more flexible with it. Either one, but I hope this helps, and I hope this is useful. Let me know. It's just different philosophies, right? Some people believe in sizing up. If you do size up your trades, right, you're gonna have bigger losers. You're gonna have bigger winners. You're gonna have less frequent trading. It's gonna be less consistent on a daily basis, but you may make more, right? The problem is what happens when you have those losers? It looks really good when someone puts up a huge winner, but can you trade with those big losers? And my point is, there's no sense, there's no reason to put your account in jeopardy when you can use constant risk sizing. If you have, until you've really proven out an edge, you've really mastered it, you've have a lot of back-tested data, but a lot of live trading data too, a lot of experience trading different markets in different contexts. Even then, that's the only time that where sizing up makes sense. But even then, you still run the risk of the setup degrading. So why size it up when you could just put a new setup or take more trades? So that's really where I'm at in it. Again, it's not, we want to trade. I'm not talking about taking lots of little trades where you don't have any size on them. I'm talking about targeting a specific size to hit your goals and stay within your risk limits. It's a very specific thing. And if you fall outside that boundary, right? If I trade too small, then my frequency will be too high. I won't be as strong, and I can recognize that. Sometimes that happens, and that's what it's really an art to fine tune that. And different markets will give you different number of opportunities. Hope that makes sense. Hope it helps. Till next time.